Hello everyone, and welcome to the Finance for Riches YouTube channel. I am your host, Chartered Accountant, Chartered Tax Advisor. I've worked for some of the biggest accountancy firms in the world and some of the most iconic brands in the world as well. Today we're going to discuss passive income. Now, this is one of those concepts which is, I guess, accepted by most financial professionals as being essential for retirement. What we're going to do though is we're going to dive into some key components on it, on the most common and perhaps not as common passive income streams. Now, passive income, what is it? It's basically generating income without having to really physically or mentally apply yourself. So I guess you could say you're making money without even doing too much. Now, this series is going to look into a whole bunch of passive income streams. In this particular video, we're going to stick with probably the simplest form of passive income out of all this, which we're going to look at. And that passive income stream is interest. So, interest, how do we derive that? Well, essentially, interest income is a type of income which person A would receive if they lent cash to person B. It's basically the cost of person A foregoing that cash. That's what interest represents, and that's what person B will pay person A. Now, how do you generate interest income? Well, the simplest and most common way is you go to a bank and you deposit money. There's different types of financial products which banks offer. So you can have savings accounts, you can have term deposits. There's also different types of interest rates that different types of accounts can offer as well. Now, what I want to do is, in assessing the type of the actual net return which you'd receive on cash deposit in a bank and the interest which is derived from that, I want to just put some numbers around this because it's quite interesting. Now, from an Australian context, the Commonwealth Bank is currently one of the options it's providing is a 0.25% per annum interest rate on a $50,000 term deposit. 0.25%. Now, certainly in Australia and most jurisdictions around the world, you got to pay tax on interest. When you pay tax will sort of depend on what type of entity is holding interest income. So we won't go into entity structures in this particular series, but we will in a future YouTube series. Now, but depending what type of structure holds the cash, the timing of when interest is taxed also varies. Let's just assume it the normal individual in this case. Now, to keep the example really basic and simple, we're going to assume a 30% tax rate. That doesn't apply in Australia. There's different tax rates which apply. And if you're looking at this from another jurisdiction, again, different tax rates could apply then as well. So best to speak to your tax professional on which tax rate apply to you. But if we just assume a 30% tax rate on the 0.25% per annum return, what you're going to actually receive net of tax is 0.175% return on interest income. On your as interest income, which is return on your deposited cash. Now, what's important to think about right now is inflation. So what's inflation? Very simply, inflation is the increase in price of goods and services. That's a very, very basic definition. The inflation rate in Australia, based on the Australian Bureau of Statistics, for September 2021, after September 2021, was 3%. So what that means is your deposited cash is giving you 0.175% interest return post-tax, while that cash is sitting in your bank account generating that interest rate. Everything else is going up by 3% in terms of our costs. Now, if I quickly do the math down here, that means that the cost of goods and services has gone up by 2.825% more than what your return is on the interest. So really, if you look at that example, putting cash into a bank account is costing you, because at the end of the periods, if we assume 1 year time frame for that interest and for that inflation, in that 1 year, that the interest from the deposit is generating 0.175% interest income. At the same time, the cost of goods and services has gone up by 3%. Now, exit strategy wise, well, its interest is quite basic in terms of exit. Not many complexities associated with it. At the end of the at the end of the term of the deposit, or if you've got the cash put into a savings account at the end of the term, when you withdraw it, you get your principal back. Generally, again, it's not taxable. But if you know overseas jurisdictions, probably check that with your financial advisor, tax advisor. But the interest is as we've discussed. So it's pretty basic from that point of view. I guess what this means is having interest as a passive income source isn't the highest form of income generation at the moment, but it's quite simple. Guys, that's the first one. In our next passive income item, we're going to look at dividends. If there's any particular financial topic you want me to tackle as well, just leave in the comments below, and I'll try to find some financial literacy on it. And if it's a topical, piece, then I'll also provide financial commentary. Also, like and subscribe. Thanks, everyone.